What's one risk that investors are underestimating in today's market?
Unanimous optimism. I think anytime consensus gets to one side of the boat tips over. And today, everyone is optimistic about the future of U.S. technology. And that's an area that you have to be careful.
Welcome to Buchanan's Counting Capital Podcast. I'm Robert Brunswick, Chairman of Buchanan Street Partners, and excited to have today's special guest, Alex Chaloff, Chief Investment Officer, Head of Investment and Wealth Strategies at Bernstein Private Wealth Management, a management arm of Alliance Bernstein, and I think also known as AB. I've had the opportunity to speak to Alex before and was really taken by both his articulation and the simplification he was able to provide of the content that can get, sophisticated at many levels. He's a University of Maryland grad, USC MBA from Marshall School of Business. And also, as he has shared, he's a very passionate reader, specifically these days in the business book arena, which is quite significant. We'll certainly get his thoughts on books. But maybe not as great as the bookshelf that he aspires to have someday as he grows his fiction side. So we'll get into that at some point. He has shared that he muses about being an editor, which would have been ideal and given him the chance maybe to read hundreds of manuscripts offering points of modification to serve the creative process. When I heard that, I kind of said to myself, sounds like he was really front running AI and what they could do today. But we'll ask him about his books, as I've mentioned. This really podcast is about education and to hear his views on what I kind of characterize as the alternative asset allocation component of portfolio construction, and specifically within private credit. No doubt, private credit has got a lot of noise in the market today, so we're going to unpack that a bit. Candidly, I wouldn't have the opportunity to have Alex join our program, given his busyness and role within AB, if it wasn't for my relationship with his father-in-law. So thank you, Steve, and welcome, Alex. Let's get started and have some good learning for our listenership. So maybe you can help us get to know you a bit by describing your background from growing up as a kid to your education and choosing the career that you now have today.
Sure. So I'm a Boston guy, East Coast guy. Grew up in Boston in what was in the 1970s and 80s the central heartbeat of the investment management space. Wall Street was Wall Street, more organized finance, but Boston was the home of asset management. And from a very early age, I wanted to be involved in investment management and asset management, and went to Maryland with an idea that I would potentially get there in a roundabout fashion through government and politics, and did that, and came back up to Boston and worked for a number of years before I came out to SC and got my MBA, and have stayed out on the West Coast now for 27 years.
You've got a big title. So help us understand just a footprint of what is AB broadly, and then what is your role within AB?
Sure. AB is a $800 billion global asset manager across traditional and alternative asset classes. So think stocks, bonds, cash management, and then a pretty significant exposure to the alternative investment space. I work in the wealth management division, if you will, the private wealth management group of AB, and we're about $160 billion. I think of myself as an RIA. A boutique, if you will, buried within this global asset manager. So it's the best of both worlds. We're able to have the scale and the heft of some of the largest groups out there, but also have this wealth management arm that's really white glove, individual relationship type of engagement.
And if you were to kind of describe or profile your typical client base for our listenership, how would you frame that?
There's probably two big groups. It's hard to lump $160 billion into any real type of categorization. Every client's different, but I think of two primary groups. One are the generational wealth investors that whose families have been wealthy and are very wealthy, and they're looking to maintain that wealth. They're looking to involve their children and potentially their grandchildren in management of the wealth. They're trying to educate them and get them engaged in making decisions on a larger balance sheet and trying to dribble in some of the details to help them be investors throughout their lives. And then the other big part of our business is for the business owner space, the beneficiaries of a liquidity event. Somebody has been running a company, whether it's a family business or a private company or a public company, for years and years, and all of a sudden they've sold it, and now they've transitioned from owning and operating to sitting on a pile of cash, and what do they do with that? And those are two very different groups. They've got different priorities, different risk profiles. They think differently. They have different experiences. And so while every client's different, I think those are the two major cohorts of clients that we serve.
That's helpful. And I'm glad you touched upon children and grandchildren of clients and educating them. A lot of our goal when we started this podcast was to do just that with the great wealth transfer, which we're going to talk about taking place. And that, I think that's valuable. And then the business owner, I think that's brilliant. You know, they've gone from no portfolio diversification when they own their businesses for the most part to now having to understand portfolio construction. And probably the basis for my next question, as I think if you could describe for your typical clients kind of the broad generic overview of a portfolio construction, asset allocation, and then more specifically for today's talk, your use of the footprint of alternatives and what that kind of includes.
Certainly. So again, it's hard to put everybody in a single bucket, but let's just try to say that there's some typical client. I can't wait to meet that typical client, though. I've been here for 20 years and I still haven't met them. But a typical client has a pool of assets that they're spending from, and whether that's lifestyle spending or legacy growth, where they're giving to future generations. Some of them spend the dollars on new ventures, or some of them, typically the business owners, want to continue to have a touch and a feel to businesses. So they want to either through an angel connection or through outright ownership, they want to continue to be involved in that community. So it's really building a portfolio that has great liquidity to it, that has income generating capability, that has some stability component to it, so that there isn't great variability in how the portfolio performs over time. And a big chunk of that, both from an income and a stability standpoint, a big part of that comes from the alternative investment sleeve that we allocate to.
Sure. So I think alternatives for many are misunderstood. So if you were to box alternatives, what they are, what they aren't, how would you characterize that?
We came up with a framework that breaks the world of alternatives into quadrants. So there's 4 categories. Real estate is its own category. Private equity is its own category. Private debt is one of them. And the last one is hedge funds. Now, secondaries, venture, that would roll into private equity. Turnaround real estate versus stabilized asset real estate, those are going to fall into the real estate bucket. As 1031s, as DSTs, as some of the more tax-driven strategies in the real estate space. So it's really those 4 buckets are catch-all categories to allow clients to understand better their exposures to the different areas of the alternative space.
With a goal, I'm sure, of both diversifying risk and also maybe providing a little bit of enhancement to yield. But what do you give up though for some of those things?
You give up liquidity. I mean, that's the one measure of control. I think you give up transparency. You know, in a stock portfolio, you can see the day after trades are logged in your portfolio. You can say you bought Microsoft, you sold IBM, you did this with NVIDIA. You don't get that level of transparency in the alternative space intentionally. By the way, it's to your benefit. Because you're getting treated as the other LPs are getting treated, and no one's getting that information. So there's some benefit to that. I also think that, frankly, there's some benefit to the illiquidity. A lot of investors have an aversion to a lockup, and they say, I want to be able to touch and feel and ask for my money, even though I never will, on a daily basis. But what you gain from that is, if you weren't a long-term investor before you invested in alternatives, you're forced to become a long-term investor. You're forced to look beyond the current headlines, and today's a great example. You're forced to be that long-term investor that maybe if you were given to your own devices, you wouldn't be.
I think that's brilliant. I'm double clicking on that. Just, it almost provides a cap on access to liquidity, or a discipline that you might not be as comfortable with yourself because of the fear of, you read the headline news, and we're going to go there now as we talk about private credit. And you really laid out private credit. I'm not suggesting within alts it's 25% of your allocation, but it's clearly a big allocation that you have within most alts. So can we talk about the growth of multi-credit from kind of a niche allocation in the market to a multi-trillion-dollar market, and maybe kind of what it is and what it isn't, and why has this significant growth of private credit happened?
Yeah, I think there's a couple of different ways to look at this. One, within that catch-all bucket for our purposes and for our clients' investment purposes, private credit is core corporate U.S. middle market direct lending. That's the lion's share. But there's also distressed debt. There's special situations. There's other types of direct lending that occur outside of the corporate space. But the biggest chunk, for sure, is that core corporate lending. I think the reason that it's exploded is twofold. One, post GFC, I know it's crazy to think back that we're still living in 2026, trying to undo what happened in 2008 and never again 2008. But it's true that a lot of banks have not changed their lending policies for 18 years. And that the fallout from 2008 was so great that they really haven't returned to provide financing in a way that they did before then. So part of this is the fact that banks are reluctant to engage, especially in the technology space, with core corporate lending in a way that they would have been able to do or willing to do 20 or 30 or 40 years ago. And then the other part of this is for the last, up until 2 years ago, 3 years ago, interest rates were so very low for 10, 11, 12 years that investors were getting 1.5% or 2% type of yields out of their portfolios in fixed income. And we're saying, basically to the industry, guys, you got to do better. And that's how private credit really took hold.
So to color that maybe a little differently, both from a regulatory standpoint and a crisis, bank retrenchment really has birthed, if you will, private credit to the level that it is today.
Absolutely. And a lot of the biggest private credit lenders used to be bankers. They used to lend from the big institutions, and now they're lending in their own entities. Exactly.
So they've kind of framed our media for us that, private credit is the next best thing. Let's go back a bit to today. Maybe this is now where the crisis is going to start. How much should we worry, Alex, about private credit's problems and them systemically impacting the marketplace, if you will?
I think that a lot of the concern is founded. There's real issues that exist within the private credit space today that are a function of the success in fundraising. So rewind the clock 5 or 6 years, when private credit was a fraction, a third of what it is today. A lot of these private lenders that are in the news today have raised not billions, but tens of billions of dollars. And they've got to put that money to work. And if they're in a room competing for a transaction against someone else that's also raised $50 billion in the last 5 years, guess what? They're going to bend. They're going to bend on coupon, not demand as much of an interest rate. They're going to bend on covenants or toss covenants out the window. They're going to make loans that in hindsight they shouldn't have made. And that's what's going on. There's a lot of I don't think there's a single day of reckoning, but I do think over the next 24, 36 months, you're going to continue to see on a pretty consistent basis failures of a number of these loans.
And might that not provide opportunities for some private credit providers to come in and buy at discounts along with, equity from private equity or whoever the buyer might be? So they could solve some of their own problem, albeit at a loss to those that originated those original loans.
Exactly. I think there's a couple of things that there's multiple layers to responding to that. I think there's two ways that private lenders will make an above average level of return on the next 3-4 years from here with new capital. One is exactly what you described, that they're able to replace financing at more attractive terms for the lender because they have the power, where 3 years ago the borrower had the power. That power has shifted to the lender today. So that's definitely happening. But I also think it's in writing of new loans, the competitive environment has changed. If you are one of these large lenders where your investors are demanding liquidity from you, the last thing in the world you're going to be doing is writing a new loan. So in that competitive process, you're no longer at the table. And the number of chairs that are filled at the proverbial table is a fraction of what it was. And that allows groups like us to lend at a rate 2.5, 3.5, 4.5. You depends on the type of company and the terms, et cetera, but higher return than we otherwise would have forecasted because of the lack of competition.
When you say 2.5, 3, or 4, you're not talking all in yield.
No, if we were lending at 7, we're talking 10.5 today. If we were lending at 8, it's a 12. It just depends. But yes, it's an additional.
So you're pitching me 3 years from now. I'm a prospective client. You're describing the private credit asset class and how this might be appropriate for my portfolio. I've heard from people like yourself that it's really its description as being less volatile might not be accurate when you think about the mark to market, the illiquidity, the redemption component. So how should we think about this in our portfolio in terms of its return today and its given its liquidity risk and its lack of mark to market on a daily basis?
I think in 3 years from now, we'll look back at this. Number one, the returns will be better than what they were on a ex post basis today. So the last 3 years, not as good as the next 3 years. So I think we'll be operating from a position of strength. I think two, just like after the GFC, after the global financial crisis, things like portfolio insurance that nobody cared about for 50 years, everyone was talking about. I think people will be talking about loss ratio and default. And we will be proud to talk about our low loss ratio, our lack of defaults. I think that's where the rubber meets the road. Not everybody is terrific at this. This is hard. This is a private loan. You're making a loan many times to a private company. There's an accelerated time frame because you're trying to get a deal done on behalf of a private equity sponsor, and the clock is ticking. And so it's up to you to do the diligence. It's up to your organization to really have comfort around a loan. This isn't something that you can go back and look at the history of publicly traded instruments and read lots of filings. The filings don't exist. So I think the wheat from the I'm really bad at like these sayings, but wheat from chaff or cream and top and this type of activity. I think the real groups that have terrific strength in underwriting and diligence will have distinguished themselves in 3 years from now.
So should we think about if we allocate money to private credit, it's kind of a high single digit to low double digit total return with most of that current? Or give me a sense for the components of that return.
I think over the next 3 years, a large chunk will be the yield, the coupon income. And so if it's a 12, that's probably 9.5 to 10. I think there's some markups that will occur. If you're like everyone is marking down their portfolio, it's just smart. It's smart. It's a responsible thing to do to say, look, even though my company is money good, even though I'm current on accruals, the loan, if I had to sell it today, I'm not going to be able to sell it at 100. I probably could sell it at 97.5. So guess what? I'm in the market down 2.5%. Over the next 3 years, you're going to get that 2.5 or 3 or 4 or 1, whatever the number is, back in appreciation. So I think that the majority of it will be in current income. Yes.
Great. So just a clarification for our audience. AB is not a direct lender themselves, or are they? Or are you really best at underwriting other managers, best of breed, and doing due diligence on them and then recommending them to your clients?
Both. We have our own business in private credit with today about 20 billion round number of capital available for finance. So that's a business that we've housed for more than 10 years in-house and has been very, I'm going to knock wood here, very successful, has avoided a lot of the pitfalls that many of the other lenders that have grown so dramatically have not been able to avoid. But we also supplement or complement rather that core private lending with some interesting ideas around the edges, more satellite type positions. And our manager research team does tremendous due diligence to determine what 1 or 2 partners could look like next to that core private credit exposure.
So I'm not going to put words in your mouth, but you could say that there's been a bit of an overreaction by the media regarding the risk of private credit overall. And I've heard you say that you're continuing to allocate to private credit. So if a client had $1, what percentage would you give him 4 managers with that $1 if for his private credit allocation?
It depends on the spending. It depends on the risk tolerance. But again, back to this typical client, if you're spending 3 to 5%, if you have a medium risk tolerance where you're willing to take on some volatility in exchange for a better than average level of growth, I would have 1 exposure to the core private credit portfolio, which would represent about 80% of that private credit bucket. And then 20% we would do around the edges in more special situations. I think distressed debt is not yet flashing alarm bells to the point that it's super attractive. That's measured by spreads, excuse me, or what a higher yielding credit would pay versus a treasury. It's not that extreme, so we're not exceptionally bullish today on distressed, but I think there's an opportunity to take advantage of some of the dislocation that's occurred because of the media, because of investors trying to get out, that I'd want to have some more of that opportunistic bucket in there to the tune of about 20%.
Sure. So you and I can recall the framing of a past market cycle and the great rotation that took place. Are you seeing allocators now rotate away from private credit at some level, even though you've kind of made a case for there could be more interesting time to invest in it? And if there's a rotation taking place, what other asset classes within alts are you seeing money flow to?
I think there's a rotation, broadly speaking, on the part of large allocators, so institutions, allocating away from private markets. They're trying to beef up their public market exposure because of still living in the shadow of what occurred in the markets in 2022. But also, I think there's a lot of, they're expressing their anxiety as an allocator by trying to move out of the illiquid and more toward liquid, which creates a huge opportunity if you're willing, as many of our investors are, to be contrarian and invest in illiquid assets today. So I think secondaries are interesting that are buying up the illiquid stakes of investors that can't hang in there for the last couple of years in a fund. I think the private credit space has an above average expected level of return. I think core private equity venture capital is interesting because I wouldn't say that companies are cheap there. That would be an overstatement. But I do think that we're starting to see less competition amongst the top private equity and venture capital funds, where we're getting exposures where we would get a slice maybe 5 years ago. We'd get 8 million or 12 million. Now they're saying, do you want 25? Do you want 30? Do you want 50? And that's because a lot of their large anchor institutional investors are taking a year or two or three or four off from allocating.
And as you look at the asset class, because you broke them down, real estate. So how does real estate behave in your portfolio, and where do you see flows coming to real estate, given where it's been in the past 3 years, given this rotation?
I think real estate is you know better than I do, is an interest rate driven investment. I mean, in many ways, the interest rate environment, and I would rewind the clock to 2022 as a recent example, the interest rate environment will create the market for you, whether it be difficult market, a more attractive market. As rates have stabilized, albeit at higher levels, that stability has worked its way through the system. I think, Robert, this might be contrarian, I think there's a great rotation going on within real estate. I think in the midst of COVID, when people were leaving Northeast cities and going in the Sun Belt, that was a huge trend in multifamily. The data tells today that that's the opposite's happening, that you're starting to see places like Atlanta, places like Colorado, other areas that were the beneficiaries of in-migration during COVID, starting to see some weakness there. So I think you can invest in real estate for value add, opportunistic. That's a little bit longer of a time frame, but higher return. You can invest in a current stabilized asset and more of a yield play, and we do both. But I think that you've got to be careful about using a 2021 or 22 playbook in 2026, 27, and 28.
No doubt there's paradigm shifts taking place that impact the use of real estate, location, and whatnot. So as I think about, we debate this here at our shop, and current return versus total return, what is kind of your standard client seems to be focused on what? And a lot of that probably depends on their age and where they are in their retirement cycle, but just kind of frame up current return versus total return.
I think that we are total return investors. I think our clients are also, if they're not, we educate them and try to get them to that total return space, because I think, private credit's a great example. Your yield this year is probably going to be about the same as it was last year. And the difference in return will be that we'll mark the portfolio down 1 or 2 or 3%. So you shouldn't be panicked that it was 12 last year and 9 this year, because your current income is still 10.5 or 11. And so there are some investors that pay attention to yield, that are very cash flow focused because they spend that cash flow. But I do think that it's all about total return, and I make allocation decisions. We build a strategic asset allocation based on total return. That's the key driver of allocation decisions.
And correct me if I'm wrong, the nice thing about alts is it can provide both. A component of it is very predictable current return-ish, and then the balance of what maybe falls within alts really has that total return, not looking to the availability for spend day one.
Yeah, that's right. There was a candy that I ate as I was growing up called Now and Laters, and that's a now and later type of thing. It's a now is the current, the later's the appreciation. Some people say I can't spend the appreciation, but I can touch it and feel it. But however you think about it, I think that's the right way. I like the now and later analogy because that works for me.
So, Alex, I'm not going to let you off on this one. I'm thinking of candy, and it would always seem like it's a now. So what was the later in a now and later candy bar?
I think it was chocolate on the outside and then like a hard type of sucker on the inside. There were two. So it was all about the melting process. But yeah, you were an impatient kid. You just crunched the whole thing. You didn't care.
So later is all about perspective, which again is probably a component of what you have to do in your job, is to getting people to think about later really being later.
Yeah, sometimes later really is later. I think private equity is a great example of that. Right now, you as an investor are buying into a market that's really interesting, but you may not see that, what we think is an above average return relative to public markets, for 6 or 7 years. I think of private credit as a great example. A lot of people have exposures that they put in place in 2015 and 16 and 17, and they enjoyed some good years, and now they're saying, boy, should I be getting out? And our view is no. Like, we think of dollar cost averaging both in the public markets and in the private markets. And we think of it as, we call it, fancy word, vintage diversification. But you want, if you have confidence in the asset class and in who is allocating for you, the manager, and things are difficult for a period of time, that's when you should be adding your incremental dollars, because you're buying in at a lower level so that you average out over time in a better place.
So we've obviously, the times we live in today are geopolitical risks, just the volatility, the political moments that we address. Can you talk a little bit about that other job you have, which is holding the hand of your clients through these volatile times that we're in today?
While it does seem like there's volatility, and certainly the war in Iran is creating stress, it's not unlike other periods. This isn't precedent setting in any way, shape, or fashion. So in a lot of ways, we can point to prior similar incidents and talk about what 6 months later look like, what 12 months later look like, what 36 months later look like. There's evidence that in a cycle like this, there are some things that are the nows. Defense, tanks, and banks, basically, is the casual way to describe what's working today. You can invest in and rotate more into literally a defensive posture, not from buying value equities or stable equities, but buying into defense companies in the U.S. and Europe and Asia. The defense. I think of this as an unassailable fact that the world has to rebuild its military infrastructure. It might not be politically correct to say that, but there's a reality there that our clients want to profit from. And I think we're able to say, look, there are some things that are working today. Even in the U.S., we have terrific market results with the backdrop that we have. There's such a disconnect between what you read in the newspaper, what's going on in the real economy, and what markets are doing. And it's the bridge, is earnings. Earnings growth should be, we came into the year expecting 12.5-ish% earnings growth. 13, 14 now seems to be home base. So far this year, we're running a 16% earnings growth number. So, there's justification for why the U.S. markets are performing as well as they have been. It's all about earnings growth. And so while it would be, it's fun, I don't want to say it's fun, it's interesting to observe what's going on in the economy and geopolitical areas, the most important thing is earnings. And if earnings are good, the market's going to be good.
So I imagine the right client for you and your education of that client over the years has really enabled them to sit through moments like this without a lot of angst, as you kind of counsel them about we've in fact constructed a portfolio to protect you for times like this. Now, are you leaning into growth maybe, or I should say value over growth in this cycle?
There are some opportunities in value that because of the technology run-up have been ignored up until this year. Some of it for good reasons. Some of them are some of what lives in the value universe are not great companies. So I wouldn't be indexing value today, but there are some interesting names in industrials, in infrastructure, in heavy equipment, in defense, that I think will be quite profitable over the next number of years. But we haven't given up on growth. I think there's a lot of concern around AI. Is it good? Is it bad? Is it productive? Is it job killer? Is the spend going to materialize into some type of ROI? There's a lot of question marks, but we continue to allocate to some of the most prominent hyperscalers there with an expectation that at the end of the cycle, we're able to identify the winners and keep capital away from the losers.
Great summary. So we mentioned earlier the great wealth transfer. So most of your clients will never spend what they have today under management, even through their retirement. So how do you counsel and teach this great wealth transfer that's going to take place, whether it's tax advantaged vehicles? Just give me a little bit of a frame about what advice you provide.
There's no one answer to that one. This is very different. We have some investors that I would characterize as generation one. So they are the either the builders of wealth or the centers of wealth. And they are a closed book with Generation 2 and Generation 3. They write the annual checks and don't involve them, and they're very comfortable with that. And they say, look, when I die, you'll pull them into a room and you'll show them what I own, and you guys will figure it out together. I'm not going to be here, and I don't really care. And that's not a insignificant percentage of clients. Having said that, there is a shift underway where a lot of our clients in that same seat have asked us for help, have basically said, that's not where I want to end up. I'd like to involve future generations. I'd like them to be smart. I don't want them to blow it. And I think I need to start now. And so whether that's giving them a portfolio of fully invested assets as a gift, and say, I'll, like you as Generation 1 will sit in on the Generation 3 meetings with the financial advisor, whether that's adding them to a family foundation so that they can see not just around the gifting and what organizations are important to the principals, but also to see how investments are evaluated, how changes take place, what are the right things to do, how to protect yourself, and use that as almost a proxy for personal investing. It runs the gamut, but I would say the majority of that G1, where I've been at Bernstein 21 years. 21 years ago, there was a much more of a ring fence attitude where there was reluctance to really engage even 50-year-old, 60-year-old children in a discussion. A lot more clients are asking for help. They don't know how to start that conversation, and they're looking for help.
Well, that is, I think you're describing it, that ring fence has now been opened for the recognition that they need to think it through for lots of different reasons. And some might not be, G2 and 3 might not be as passionate about the investing as the original creator of the wealth. So you need to think about what assets you're transferring.
And I think that there too, it's interesting. A lot of the long dated private equity, venture capital, real estate type investments that take 10 plus years to materialize, what I've seen in my discussions, and again, I'm meeting with our largest clients, so this isn't really a full sample size, but what a lot of that group is doing is saying, I want to give dollars invested already in these private funds so that they can learn, they can read the commentaries, they can listen to the portfolio managers, they can understand, but they can't do anything about it. And it's like, in that way, the illiquidity, those handcuffs are a good thing because they don't allow for any error. Right.
Well, you've reassured me that I'm doing a few things okay as it pertains to my own next chapter family. As we kind of be mindful of your time and bring this to a close, speaking about young listeners, we have a lot of them on the podcast. So what advice might you provide, for themselves as they pursue a career, maybe in the career that you're in, and how they should look at it today? Because it's a lot different than when you and I started in business.
Absolutely. I mean, I think of my first job search was reading the Boston Globe job section on Sunday, having a typewritten resume and a cover letter, putting it in an envelope and mailing it, and waiting for a phone call to arrange for an in-person interview. That is gone. That's gone. And now kids in a day can apply to 100 or 200 or 300 jobs. And so your resume may not ever be seen by a person. And so really broad advice for regardless of what industry you're going into, I think, is to understand AI, to use AI. Don't fear AI. It's not a bad thing. And frankly, that will distinguish you among other applicants, because I would not discount the importance of, Robert, I'll just say people my generation, I won't say your generation, and our lack of ability to navigate AI effectively. I I think that's really an issue where candidates who are evidence that they can build agents, that they're using AI effectively. Like as a hiring manager, I want that person. That's a person I want to engage with. That's somebody that I want to move to the next round and potentially hire. So I would say leveraging AI and not fearing it is a big part of the job search today.
And where does EQ versus IQ come into the equation as you look to build your roster?
Well, there are some roles that for better or for worse don't really require high EQ, and that's okay. The world, it takes a village type of approach. You don't necessarily need to have everybody have a 10 out of 10 on that. It's great to have terrific interactions and be able to work with people of all types, of how they process information, about how they go about work. I mean, I have people on my team that I can give them 2 bullets and say, this is the project, and they're gone. I don't hear from them for 45 days, and they come back with a finished product that's 90% perfect. I have other people that say, let's schedule a meeting. I need an hour to talk about this. I'll need a day to process. Let's talk again on Friday. So I think if you want to run an organization, you need EQ. You need to be able to work with everybody. You need to be able to understand this person's has different needs. By the way, they both get to the finish lines and they both are fabulous contributors. But it's a different way of getting there, and you need to be able to adapt. They don't need to be able to adapt to you. You have to adapt to them, and that's the key component.
Wonderful. I said early on that I was going to ask you about your books and your reading and that passion you certainly have. So share with us 3 that you might recommend, 3 favorites that are fairly recent that might have some application. They're probably business books, I assume.
I read a lot of nonfiction. I read a lot of fiction. To me, reading can take 2 places. One is just rest and relaxation. My East Coast friends make fun of me that I'm peak California. And one of the things they tease me about is I did have a sleep coach. And so we talked about when the devices had to be turned off and time between last check-in on screens and lights out. And books are a big part of that bridge to get you from a busy workday to a place where you can decompress and sleep. But I lean on some of the older, like the classics, if you will. I think Good to Great is a great book. You mentioned my father-in-law, Steve, and I agree on Built to Last and I actually named my quarterly letter this quarter Built to Last. And then I think one of the nonfictions that I've enjoyed and I pick up over time is Lords of Finance. It's a book about post-World War I Germany and the inflation that took hold, not so much as a catalyst for World War II, but I read it and I think about what could happen in an inflationary period today, and what are some of the signals that we should be looking for not just 2.5 or 2.75, but 5 or 6% inflation rates on a persistent basis. So I think that those types of books are helpful just from an organizational structure standpoint, but also to look a little bit at history to see what's important.
Thank you. We've absolutely had some good learning with you today, and I think the description of private credit, what it is, what it isn't, why it still commands a spot in a diversified alternative asset allocation, the opportunity set that might be there going forward. I think that's quite instructive. And you obviously have a big job, and you represent well AB, so I'm sure they're quite happy with you. And I love tanks and banks. I understand you use AI. Don't fear AI. Distinguish yourself. Just as advice to younger people as they lean into their career path is really wonderful. So thank you for joining us today on Counting Capital. We'll look forward to having you back. You're a wealth of information. And as I said earlier on, I love the way you articulate and frame what can be a very complex subject matter. So thank you very much. We look forward to having you back.
Great. Thanks, Robert. Thanks for having me.
Thank you for joining Buchanan's Counting Capital podcast. We've had some good learning today, and I look forward to our next episode together.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.